Okie dokie. Okie dokie, everyone. Can I start off by saying either a very good morning or a very good afternoon or even a very good evening, of course, depending on where you are around the world. Welcome and thank you for joining me tonight on tonight's latest episode of the Discover Trading series. Written by myself, of course, which is James Alexander. I'm the Chief Market Analyst here at Wise Bank. Tonight's episode is called Discover How to Trade Using Moving Averages. Now, before I get on tonight's agenda, let me give you a little introduction on myself. This sultry figure here you see here is me. I'm the Chief Market Analyst here at Wise Bank. I have over 20 years experience in the financial service industry. I actually started off as a mortgage broker in the UK. As you can tell, I'm a Brit, so don't hold that against me whatsoever. So I started off in mortgages, doing commercial mortgages, specializing in buy-to-let and commercial property. I moved into pensions and alternative investments before obviously getting into trading and online trading arena around about 13 years ago. I've traded myself through a prop company in Dubai. I specialized in gold. I was a big gold bug back then. In fact, just to let you know how long ago it was, back then gold was trading around about $683 an ounce. So that was quite some time ago. I'm indeed a published writer. I've been published in several leading industry publications, including the likes of Financial Times, Market Watch, and several newspapers in UK and globally. I'm an avid market commentator. I'm extremely passionate about this market, very excitable, and I actually really, I really love the markets, and I enjoy talking about it. And I'm also, at the same time, a well-known public speaker. And I've spoken at events in Singapore, the UK, obviously, Dubai, Kuwait, Qatar, and recently South Africa, both in Joburg, Pretoria, and Cape Town. Now, tonight's latest episode of Discover Trading, tonight is all about moving averages and how you can use moving averages in your trading. So, because it's technical analysis based, we first of all talk about technical analysis, what technical analysis actually is. Then we'll discuss the theory behind technical analysis. Then we'll go through some examples of technical indicators. And of course, then we'll move on to the main core of tonight's episode, which is all about moving averages. So we'll start talking about simple moving averages to begin with. And then we will discuss, I will look at some examples of simple moving averages at work, seeing how they can work at both as a support and resistance and help you identify a potential trend, etc. Then what we'll do after we looked at some of these examples, we'll then discuss something which, again, occasionally can indeed work and is extremely useful, which is, of course, the moving average crossover, and we'll discuss the theory behind that. Then we'll go into an introduction on exponential moving averages. So as you see, we'll talk about simple, and we'll talk about exponential, and we'll end up with the simple versus the exponential, which is the better one to use, and really what sort of trading style that will fit into. Then we'll talk about the other events, educational events, the other episodes of the Discover series we'll have this month. And then, of course, the simple question and answer session where anybody or everybody can ask their questions, and I'll be more than happy to answer them for you at the end. So, what is technical analysis? Obviously, we have several methods of trading. You have fundamental analysis, you have obviously market sentiment, but what is technical analysis, which seems to be incredibly popular? Technical analysis is a method of trying to establish potential future direction of an asset by studying past price data and volume. The theory behind technical analysis is that previous trading activity can give, in the theory, give a better indication of what direction an asset may go. Now, the basic concept was developed from the Dow theory, from the writings creatively named by a chap or an individual be called Charles Dow. The Dow theory believes that price movement is not random, but in fact follows patterns and repeating trends. Now, some of the example of these technical indicators or technical analysis or indicators people use in technical analysis includes the likes of the relative strength index, which is an oscillator, stochastics, which is also a type of oscillators, the MACD, the moving average convergence divergence, which is also an oscillator, Bollinger Bands, trend lines, and of course, simple moving averages and exponential moving averages. Both we will discuss tonight. Now, a simple moving average or simple moving averages, simply known as the a shortened down version is as the SMA. Now, simple moving averages are calculated by adding up the recent closing price of an asset and then dividing it by a certain period of time. That sounds really good, James, but what does that actually mean? Okay, for an example, you have a simple moving average of 10. Okay, now, how it's calculated, and you don't forget, you don't have to do this for you. The indicator does it for you. You just simply have to add the parameters into this indicator for it to do it. What this SMA does, okay, how it calculates it, it takes the closing price of an asset over, say, 10 trading sessions. It then divides it by 10, and that's how it is calculated. All right? Again, you don't have to do these calculations yourself. The indicator would do it for you. Now, the use of a simple moving average, or how some traders use a super simple moving average, is they use it to try and identify a trend and use it to spot potential support and resistance levels. Now, here's the theory. And here we have the euro dollar on a daily chart. Let me grab my little pen here, my laser pen. Now, excuse me, the theory is if the asset is trading above the simple moving average. Now, the simple moving average we have here is the blue line, okay? The blue line. And we have a simple moving average at the moment of 20, which basically means the simple moving average is calculating the closing price of an asset over the last 20 sessions divided by 20. The theory is that if the asset is above the simple moving average, it's on an uptrend. If the asset is below the simple moving average, then it's on a downtrend. The theory also says that if it's above the moving average, not only is it on an uptrend, but that moving average line will then act as a support, i.e. the area where the market might start to buy in again. As well as that, if the asset is below the simple moving average, the theory is that instead of acting as a support, it acts as a resistance where the market will start to sell off again. Sell off again? Ugh. Sell from again. So let's have a look. Euro dollar goes above the moving average, uptrend. Comes down, tests the simple moving average, the market starts to buy in again. It does indeed act as a support on these trading sessions. Breaks above it again, tests it, and it does indeed act as a support, as it does indeed act as a resistance when it's underneath it. Breaks below it, goes on a downtrend. And indeed, the SMA then acts as a resistance because though it's on a downtrend, it tries to break it and the market starts to sell off again. So indeed, it does act as a resistance. And it does here. Market retraces back up, hits the SMA, and guess what? The market starts to sell off again. So then in theory, on this occasion, the SMA is giving us the indication of an uptrend, downtrend, and potential support and resistance. Let's look at a different time frame and a different asset. This is the British pound, USD on a 30-minute chart. There's our SMA. Again, it's a 20. Let's see what happens. Goes above the SMA, breaks the SMA, and indeed it goes on an uptrend. SMA acts as a support as the British pound is on an uptrend. Breaks below it and does indeed, in this period of time, go on a downtrend. And yes, indeed, the SMA acts as a resistance. Breaks above it, acts as a minor resistance, and then finally breaks below it again, going on a downtrend. And as you can see, the SMA acts as a resistance. Let's have another example. This is gold on 1 hour. SMA is the blue line. Every candle, don't forget, represents 1 hour. It's a 1 hour chart, this one. Breaks below it, does indeed go on a downtrend, and does indeed, the SMA acts as a resistance. Every time it tries to break above it, the market sells off it. Eventually, it does break above it, and gold goes on a small uptrend, but then it does indeed break, go on a downtrend for a period of time, where, of course, it acts as a resistance, forcing the asset down till this little minor break here. But then it breaks again, goes on a downtrend even further, and as we can see, it does indeed act as a resistance. Let's do one more. Let's look at indices. This is indices on a daily. Industry on a daily. So don't forget, DAX on a daily. Okay, each candle represents 1 day. There's our moving average. Breaks below it, goes on a downtrend. Breaks above it, goes on an uptrend. This time it does indeed, as it's on an uptrend, act as a support as the market starts to buy in again. Breaks below it, goes on a downtrend. Breaks above it, goes on an uptrend. Breaks below it, eventually, after obviously the SMA acted as a support, finally does break below it, and then goes on a downtrend. And here, as we can see right now, the DAX is testing it. Now, that's one way how people use an SMA, a simple moving average. There is another theory. And the other theory is in relation to the moving average crossover. Now, a moving average crossover, here's the theory. A moving average crossover can help identify if a trend is about to change, which can then enable a trader to be prepared and to get a better entry level. The crossover happens when a smaller SMA crosses over a large SMA. That sounds fascinating, James, but explain, what do I mean by that? What I mean by that is if you have a small SMA of say 10, so an SMA calculating the closing price of an asset over 10 days divided by 10, and then you add a SMA of 20 calculating the closing price of an asset of 20 closing prices divided by 20, that is the larger SMA. The theory is if the smaller, i.e. the 10, crosses above the 20, indicates the trend is going up. If it crosses below, then it indicates the trend is going down. Let's have a quick look at this and some examples. So again, this is the euro dollar on a daily. So the smaller SMA is the blue. That's the 10. The larger SMA is, I guess it's purpley pink. That's the 20. So remember the theory. The smaller crosses the larger, uptrend. The smaller crosses below the larger, downtrend. Let's have a look and see how this happens. The smaller crosses the larger, uptrend. The smaller crosses below the larger, downtrend. The smaller crosses the larger, sort of a small uptrend. The smaller crosses the larger again, at this point, downtrend. The smaller crosses the larger, uptrend. And then here, the smaller crosses the larger, downtrend. Let's have a look at another example. This is the dollar yen on 1 hour. Remember, the blue is the 10, the smaller SMA, and the pinky purple color is the larger, the 20. Let's see what happens. The smaller crosses the larger, downtrend. The smaller crosses above the larger, nice uptrend. The smaller crosses the larger again, nice downtrend. Smaller crosses the larger, uptrend. And the smaller crosses below the larger, downtrend. And then, of course, obviously crosses the larger, this larger again, uptrend. One more example. This is the Australian dollar USD on a 30-minute. Now remember, okay, the theory is the smaller crosses the larger, uptrend, smaller crosses below the larger, downtrend. Okay, so we have our 10, we have our 20. The purple on this occasion is the smaller, it's the 10, and the 20 is the larger. So see what happens. Crosses below the larger, downtrend, crosses above the larger, uptrend, crosses below the larger, downtrend, and then crosses above the larger, uptrend. So that's on a 30-minute, the Aussie dollar. Let's do one more. And this, I actually want to illustrate this point as well, why the SMA or the moving average crossover can work and sometimes doesn't work perfectly. Okay, because here's the thing, and I will say this, I'm always open with everybody whenever I'm talking about education. It works sometimes, but it doesn't always work. If it always works, of course, we'd be multi-millionaires. So, you know, this is the thing. So remember, the 10 is the purple and the blue is 20 on this example here. And here's the thing. This is the question people often ask. When I see it move above, do I jump in? No. Why? I wait to see the gap between the two and see how large it becomes. Because as we can see at this point, the smaller has indeed gone above the larger, but they're so close together, is telling me that the market, instead of going on a trend, is going on a ranging. I would wait till I see a proper gap like this. because that illustrates then there is a movement indeed for an uptrend. And as we can see, it breaks away properly. It was very, very, very tight here, very close. Almost, you cannot see the difference between the two. But when you start seeing the gap around here, that's when you possibly look at jumping in. And indeed it does. It does the same here. Comes down, comes down, comes down. Breaks below it. Not to about here when you see a big enough gap. Are you confident that indeed the trend has changed and it is indeed going on a downtrend? Now, that's simple moving averages. Let's talk about exponential moving averages, which is known as EMA. Creative, right? Very creative. Now, as we've discussed, the simple moving average calculates the closing price of an asset of a period of time divided by that period of time. The danger, of course, with an SMA is that it can be affected by sudden spikes that might be a one-off. What do I mean by that, James? Before I go on to the next bit, what do you mean by that? So say, for example, you take a closing price of gold. Say it was 12.86, 12.85 next day, 12.82, 12.56, 12.60, and then one day it was 13.10, and then it goes back down to 12.56. Okay, that sudden spike could chuck out the calculations. What exponential moving average does is, instead of calculating the 10 closing prices, okay, and then dividing it by 10 as an example, what it does, it pays more attention to what has happened on the more recent trading sessions. What do you mean by that, James? Well, simple as this. You take the 10 closing prices like a simple moving average, but day 8, 9, and 10 takes more of the focus. What has happened more recently? That becomes more of the focal point of the calculation than just simply calculating the average of 10 closing prices. It focuses on what's happened more recently. Because of this, the theory is that traders are more focused on what is more happening more recently than they are where the market has been going previously. They focus on more of the most recent trading sessions. So what really that means is that the the EMA, follows more closely the chart, or where the actual price is. Now, here's another example, okay? We have the SMA, which is the simple moving average. Remember, it calculates the closing price of an asset over, say, the last 10 closing periods divided by 10. And we have the EMA here. This time it's the blue, okay? Still doing the same. Closing price of an asset, 10 days, 10 divided by 10, but more focus on, say, day 8, day 9, day 10. And what you can see is, look, the EMA, the purple, reacts quicker than the simple moving average. It's more directly related to the price because it's focusing on what's happened recently. Now, one of the other theories, again, it's like the crossover, is that if you have an EMA of 10 and an SMA 10, if the EMA crosses below the SMA, then again, it indicates potentially where the direction the market is going because it's following the prices more closely. Let's have a look at my example here. As you can see, I can see the purple, which is the EMA, is really, really close to the bars, the candlestick, whereas the blue, which is the simple moving average, there's a fair bit of distance, but the EMA is really, 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 really close to the price. So the theory is that when it breaks below, okay, it gives the indication that the direction the market is going. And as you can see, as soon as because it follows it, actually, the EMA is the blue, actually, and the simple moving average is the purple. So as you can see, the blue line is really, really close to where the market is going. So the idea is that if the EMA, in this case the blue, crosses below the SMA, is following the price more closely, indicating where the market could possibly be going. As you see, it breaks below, silver prices drop. Breaks above it, silver prices go up. And as you can see again, breaks below it, silver prices start to move downwards. And let's do one more example. This is Apple. Let's do some stocks. So I'm doing currencies, I'm doing commodities. Let's look at some stocks. This is Apple on a daily. Again, don't forget the blue is the EMA. Okay, and the purple is the simple. And again, the theory is the blue crosses the purple, the EMA crosses the simple, uptrend, etc. It does indeed. It follows the price very, very close. Then it starts to react a lot quicker, indicating a potential downtrend, and indeed it does indeed drop there. And as we can see, again, it crosses above, moving more closely to the price of the asset than the simple moving average. And again, of course, it breaks below it, indicating a potential downtrend. So what is better, the simple moving average or the exponential moving average? Let's look at the two and compare the two. SMA. On the plus side, it can give you a smooth indication of direction, and it cancels fake outs. So it gives you an overall picture of where something might be going. Negative, it's slower, which could also cause a lag in sell and buy signals. EMA plus, it's faster. It calculates the recent price movements. It focuses on what has happened recently, making it more faster of an indicator to tell you when something is changing. Negative, because of this, it can fall foul to fake outs and give you incorrect signals. Now, future educational events coming up for the rest of November. On the 13th of November, we have Discover Risk Management, the latest episode. Then on the 22nd of November, I'm doing a case study requested by one of you fine individuals who've asked me to do this. I will be doing Discover Gold Trading. That's on the 22nd of November. And finally, on the 29th of November, the final one for the month, something which I'm very keen and passionate about. I'll be discussing Discover Why Fundamentals Matter in Trading, and I'll be going into that. Now, if you wish to contact me, by all means, please email me at james.t@wisebank.com. Other than that, it's a new account I've just set up. You can follow me on Twitter, which is, my handle is @JamesAlexanderT. T is my middle name. Join me at James Alexander T. On my Twitter account, which is my handle there. Again, it's a new account. I've just set it up, but you'll see I regularly will publish on a daily basis charts, levels I'm watching, major events, and if I see an opportunity in the market, I will share that with you on my Twitter. So please come along and follow me on that, or direct message me if you like on Twitter. So, on that note, any questions at all? You can ask me anything. If I know the answer, I will certainly answer it for you. So yeah, please ask me anything related to what we've just discussed. Please carry on. Any questions at all? Please don't be shy. Give it a try. Did it at least make sense? Was everything clear and you understood what I was saying? Or was there anything you'd like me to go back on and discuss again? Did everybody at least enjoy it though, or find it useful? Boris, I liked it a lot. Thank you very much, James. Bless you. Thank you, Boris. I'm glad you found it useful. What part did you like most, Boris? The explanation on exponential moving averages. What's the difference? Yeah, I think because a lot of people don't actually understand it. When they say, usually when people talk about moving averages, they automatically just really refer to simple moving averages because it's the easiest explanation. But when then people move on to, exponential, that, like I say, it has its own advantages and disadvantages, obviously, and the explanation to what that is good. Is there any other questions at all? Everybody at least enjoy it. I know Boris did. Oh, Carl. Yes, thank you very much, James. Enjoyed it. Could you maybe do one on indices? Yes, I'll certainly look at doing one on indices, definitely. Oh, Caroline as well. Yeah, okay, Caroline. You like the crossover part? Okay, that's good. Very good. Okay. Is there any other questions at all? Anything else anybody would like to ask me? No, I'll make a thank you. Thank you, Boris. Okay, well, in that case, can I thank every single one of you for joining me tonight? I really appreciate you taking the time out to join me tonight. And I look forward to seeing you all sometime next week. On that note, can I wish every single one of you either a good morning or a good afternoon or a good evening or even a good night, depending on where you are around the world. Till next time, every single one of you, trade safe.